Unlock the secrets of Warren Buffett's investment genius as we decode the blueprint behind his remarkable wealth-building strategies. Welcome to another episode of Investing Insights. Today, we're diving deep into the investment strategies of one of the most legendary investors of all time, Warren Buffett. Often referred to as the Oracle of Omaha, Buffett's approach to investing is straightforward, yet incredibly effective. In this video, we'll break down Warren Buffett's investment philosophy into 9 key steps, explore his real-world investment examples, and discuss the stocks he prefers to invest in. So, without further ado, let's begin. Number 1. The margin of safety. Let's kick things off with the first step in Warren Buffett's investment philosophy, the margin of safety. This concept is at the core of his approach. Imagine buying a stock for $10 per share when its true intrinsic value is $12 per share. That $2 difference represents your margin of safety, protecting you from potential losses. Warren Buffett's mantra is simple: always aim to pay less than a company's intrinsic value. As he wisely puts it, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Number 2, quality matters. Buffett's second principle is all about quality. He doesn't invest in struggling or mediocre businesses, no matter how tempting their stock prices may seem. He advises investors to buy a wonderful company at a fair price, rather than a fair company at a wonderful price. Quality is key in his book. Number 3, don't follow the herd. In today's fast-paced, information-saturated world, it's all too tempting to follow the crowd when it comes to investing. Warren Buffett, however, advises against this common pitfall. His timeless wisdom encourages investors to resist the urge to blindly buy or sell stocks, simply because everyone else is doing it. Buffett understands that true investing success lies in independent thinking. He emphasizes that the most critical quality for an investor is temperament, not intellect. This means having the discipline to avoid being swayed by the herd mentality. Whether stocks are soaring or plummeting, Buffett believes in sticking to your own investment thesis and doing your homework. By ignoring the crowd and focusing on your own research, you're more likely to discover hidden gems and make sound investment decisions that can lead to long-term success. Number 4, embrace market volatility. Warren Buffett's approach to market volatility sets him apart as a legendary investor. While many people fear stock market crashes and corrections, Buffett eagerly welcomes them as opportunities rather than threats. He understands that market fluctuations are an inherent part of investing and that they create favorable conditions for those who are prepared. Buffett's perspective is clear. When stock prices tumble, it's akin to a store-wide sale with deep discounts. He doesn't shy away from buying quality stocks at reduced prices during these turbulent times. In his own words, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. This mindset has led him to make some of his most profitable investments during turbulent times. Number 5, think long-term. Warren Buffett's enduring success is rooted in his unwavering commitment to long-term thinking. He famously advises, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Buffett doesn't speculate on short-term price movements. Instead, he selects investments with the intention of holding them indefinitely. While he does sell stocks when circumstances change, his default mindset is buy and hold forever. This long-term perspective allows him to weather market volatility, take advantage of compounding, and focus on the fundamentals of a business. It's a lesson for all investors. Success often comes to those who patiently nurture their investments over time. Number 6, don't be afraid to sell. Buffett acknowledges that sometimes the investment landscape changes. He reminds us that when you find yourself in a hole, the best course of action is to stop digging. Even though he aims for long-term holdings, he isn't afraid to sell if the fundamentals of a company deteriorate. A prime example is his exit from Freddie Mac before the 2007 to 2009 financial crisis, a move that proved to be wise. Number 7, the value of value investing. Warren Buffett's investment strategy is synonymous with value investing. a philosophy that centers on acquiring assets for less than their intrinsic worth. This approach is built on the belief that the market often misprices securities, offering opportunities for astute investors. Value investors, like Buffett, seek out companies whose intrinsic values exceed their market valuations. They meticulously analyze financial statements, assess business fundamentals, and identify stocks trading at discounts. By purchasing these undervalued assets, they anticipate that over time, the market will recognize their true worth, resulting in substantial profits. Warren Buffett's success as the world's most renowned value investor exemplifies the effectiveness of this approach. His portfolio includes companies like Coca-Cola and American Express, which he purchased when they were undervalued, and their stock prices subsequently soared. Number 8. The magic of compounding. One of the most enchanting aspects of Warren Buffett's investing journey is his mastery of the art of compounding. Buffett's wealth isn't solely the result of smart stock picks, it's the consequence of harnessing the astonishing power of compounding over time. Buffett employs various compounding mechanisms in his investment strategy. He reinvests dividends, capital gains, and operating cash flows generated by Berkshire Hathaway's subsidiary companies. This continuous reinvestment has propelled Berkshire's annualized returns to a staggering 20.1% since he took the reins in 1964, far surpassing the S&P 500's 10.5% return over the same period. To put this into perspective, a $1,000 investment in Berkshire Hathaway in 1964 would have grown to over $600,000 by 2023, compared to about $92,000 if invested in the S&P 500. This exemplifies the astonishing potential of compounding wealth over the long term. Warren Buffett's success is a testament to the profound impact of patient, long-term investing and the awe-inspiring magic of compounding, which can turn modest investments into substantial wealth over the years. Number 9. Research and reflection. Finally, we come to Warren Buffett's insatiable appetite for knowledge. Contrary to the image of a high-paced, hyperactive trader, Buffett often spends his days in his office in Omaha, Nebraska, doing something that may surprise many: sitting and thinking. Buffett recognizes that knowledge compounds over time, and he attributes much of his success to the relentless pursuit of investment wisdom. He has been quoted saying, "I insist on a lot of time being spent almost every day to just sit and think." This dedication to research and reflection is a cornerstone of his investment strategy. Buffett immerses himself in financial reports, books, and industry analyses, continually expanding his understanding of the markets and businesses. He doesn't make hasty decisions. Instead, he carefully evaluates every potential investment, seeking to understand the underlying dynamics and competitive advantages. Warren Buffett's investment strategies are rooted in simplicity and discipline. From the margin of safety to the power of compounding, his approach offers valuable lessons for investors of all levels. By understanding and applying these principles, you can embark on your own journey toward financial success. So are you ready for it? Let us know in the comments section below. And if you found this video informative, then don't forget to hit that like button and subscribe to our channel for more amazing content. Thanks for watching, and we will see you in our next video.